How to start investing with just $100. What's going on, everyone, and welcome back to the channel. Listen, I get it. Investing can seem super intimidating, especially if you're just starting out and don't have a ton of cash to throw around. You might be thinking, investing? Isn't that just for rich people with thousands to spare? Well, I'm here to tell you that's totally not true. Today, we're gonna bust that myth wide open and show you how you can begin your investing journey with as little as $100. That's right, just one Benjamin Franklin can be your ticket to building long-term wealth. We'll walk through everything step by step, from choosing the right platform to understanding different investment options, all in a way that's easy to understand even if you're a complete beginner. So buckle up, grab your metaphorical piggy bank, and let's get started. Before we jump into the nitty-gritty of how to invest, let's take a minute to talk about why you should even bother in the first place. See, most people just park their hard-earned money in a traditional savings account, right? But here's the thing. Those accounts typically offer interest rates that are, let's be honest, pathetic. They barely keep up with inflation, which means your money is actually losing value over time. Investing, on the other hand, gives your money the potential to actually grow. It's like planting a seed. You put your money into something that has the potential to increase in value over time, like stocks, real estate, or even a small business. And just like a seed needs time and the right conditions to grow, your investments need time and the right strategy to flourish. Now, I know what you might be thinking, investing comes with risks. And yeah, that's true. But here's the thing, not investing is even riskier. Think about it, if you're not growing your money, you're losing purchasing power every single day because of inflation. It's like trying to run up a down escalator. You have to work twice as hard just to stay in the same place. By investing, you're not just trying to keep up with inflation, you're aiming to outpace it and actually build wealth over time. Alright, so you're ready to start investing? Awesome. The first step is to figure out where you're actually going to put your money. Think of it like choosing the right gym for your financial fitness journey. You want a platform that aligns with your goals and makes you feel comfortable. Now, there are a ton of different investment platforms out there, each with its own pros and cons. First up, you've got your robo-advisors like Betterment or Wealthfront. These are great for hands-off investors who want someone else to do the heavy lifting. You basically answer some questions about your risk tolerance and investment goals, and their algorithm creates and manages a diversified portfolio for you. Pretty cool, right? Then you've got your more traditional stock trading apps like Robinhood, Webull, or eToro. These platforms give you more control over your investments, allowing you to buy and sell individual stocks, ETFs, and even options. But with great power comes great responsibility, right? You'll need to do your own research and make informed decisions. And finally, if you're just starting out and want to dip your toes in with smaller amounts, micro-investing apps like Acorns or Stash can be a good option. These apps round up your everyday purchases to the nearest dollar and invest the spare change for you. It's a super easy and painless way to start investing without even thinking about it. So, take some time to explore different platforms, compare their fees, features, and investment options, and choose the one that feels like the best fit for you. Remember, there's no one-size-fits-all solution here. It's all about finding what works best for your individual needs and preferences. Chapter 3, Step 2, Where to invest your first $100. Okay, you've got your platform set up, you're feeling good, now it's time to decide where to actually put your hard-earned $100. And let me tell you, there's no shortage of options out there, but don't worry. We're gonna break it down into 3 main categories to make it super simple. First up, we've got ETFs or exchange-traded funds. Think of these like baskets of stocks that track a specific index like the S&P 500 or the NASDAQ 100. ETFs are great for beginners because they offer instant diversification. Instead of putting all your eggs in one basket by buying individual stocks, ETFs allow you to spread your risk across hundreds or even thousands of companies. It's like investing in the entire stock market with just one purchase. Next, we've got individual stocks. This is where you get to be your own Warren Buffett and pick and choose specific companies that you believe in and think will grow in value over time. Now, stock picking does require more research and due diligence than ETFs, but it can also be incredibly rewarding if you pick the right companies. Just remember, it's important to diversify even within individual stocks. Don't put all your money into just one or two companies, no matter how promising they may seem. And finally, If you're looking for a safer option with lower risk but also lower potential returns, you might consider high-yield savings accounts or bonds. These options won't make you rich quick, but they offer a relatively stable way to grow your money with minimal risk of losing your principal. They're like the tortoise in the race. Slow and steady wins the race, right? Chapter 4, Step 3, Set goals, stay consistent, and watch your money grow. Alright, so you've chosen your investment platform, you've decided where to invest your first $100, now what? This is where the real magic happens, setting goals, staying consistent, and letting the power of compound interest work its wonders. See, investing isn't about getting rich quick. It's a marathon, not a sprint. It's about making smart, informed decisions and sticking with them over the long haul, even when the market gets bumpy. So before you even think about buying your first stock or ETF, take some time to define your investment goals. What are you saving for? A down payment on a house, early retirement, your dream vacation? Having clear goals will not only keep you motivated but will also help you determine your investment timeline and risk tolerance. Once you have your goals in mind, it's time to develop a consistent investing strategy. Now, this doesn't mean you have to become a day trader glued to your screen 24/7. In fact, I'd highly advise against that. Instead, focus on building a sustainable habit of investing regularly, whether it's monthly, quarterly, or even annually. The key is to make investing a non-negotiable part of your budget, just like paying your rent or your phone bill. And here's the beautiful thing about consistent investing. It allows you to take advantage of the incredible power of compound interest. Compound interest is basically interest earned on interest. It's like a snowball effect for your money. As you invest consistently over time, your earnings start to generate their own earnings, and then those earnings generate even more earnings, and so on. It's like a magical money-making machine that just keeps growing and growing. Chapter 5. Avoid these common investing mistakes. Alright, we've covered a lot of ground today, but before I let you go, I want to leave you with some important tips on what not to do when you're starting out with investing. Avoiding these common mistakes can save you a lot of headaches and heartaches down the road. First and foremost, don't try to time the market. You might hear people talking about buying low and selling high, but the truth is, even the most experienced investors can't predict with 100% certainty when the market is going to go up or down. Instead of trying to time the market, focus on time in the market. The longer you stay invested, the more time you have to ride out any short-term fluctuations and benefit from long-term growth. Speaking of riding out fluctuations, it's crucial that you only invest money that you can afford to lose. Investing always involves some level of risk, and while the goal is to grow your money over time, there's always a chance that you could lose some or even all of your investment in the short term. So, never invest money that you need for essential expenses like rent, groceries, or your emergency fund. Another common mistake to avoid is putting all your eggs in one basket, or in investing terms, not diversifying your portfolio. Diversification is key to managing risk, because it ensures that even if one investment performs poorly, others can help offset those losses. Remember those ETFs we talked about? They're a great way to achieve instant diversification. And finally, don't get discouraged by market dips or corrections. The stock market is like a roller coaster. It has its ups and downs. It's perfectly normal for the market to experience periods of volatility or even decline. But here's the thing. Over the long term, the stock market has always trended upwards. So, instead of panicking and selling your investments when the market dips, try to view these dips as buying opportunities. Outro, start building your future today. So, there you have it. We've covered a ton of information today, from why investing is crucial to how to get started with just $100. Remember, the most important step is to simply start. That $100 might not seem like much, but it's the first step towards building a brighter financial future for yourself. Choose your investment platform. Decide where you want to invest your money, whether it's ETFs, individual stocks, or something a little more conservative, and most importantly, stay consistent. Investing is a marathon, not a sprint. And the key to success is to stay the course, even when things get bumpy. And hey, if you found this video helpful, don't forget to give it a big thumbs up. Subscribe to the channel for more awesome financial tips and tricks, and hit that notification bell so you never miss an upload. Now I want to hear from you. What's the first investment you're going to make? Let me know in the comments down below. Thanks for watching, and I'll see you in the next video.